10-year swap rate. This is pretty close to the truth. Okay. Efficient markets, current level of prices reflects all available information. All actors are rational. They process the information with equal competence. Now, there is one term here which is called naive capacity. Basically, suboptimal players in the market. But notwithstanding that, professional players process information with equal competence. Price moves are random. No player can willfully cause the markets to move in his favor. You cannot control the markets. You can borrow and lend money in a frictionless way, and all this comes down to the standard model, which is geometric random motion with a process. Okay? So this is the markets. There isn't going to be much math now. Don't worry. Now, outside the financial markets, a lot of these assumptions do no longer hold. Information is limited and may be available only at substantial cost. Okay? When I talk about the price of oil, I could say that oil trades in an efficient market. But when I talk about oil exploration, there I have limited information, and it could be that I can only retrieve information at a very substantial cost. Okay? Players may be able to resolve uncertainties in their favor. Players can move the quote-unquote market in the real world. I can lobby to have a law passed. Okay? I can offer money to buy out a competitor. No, I can resolve uncertainties in my favor, obviously at a cost, but still there is at least a theoretical possibility of doing that. When I trade euro-dollar, no matter at what cost, I cannot move the dollar unless I'm the Fed, or Soros. Money supply may be limited. Very importantly, players may be unable to buy or sell assets at desired quantities, if at all. And this is a key element in option theory, in real option theory. Okay? Also, we have much more complex distribution of uncertainties specific to each problem at hand. Now, decision analysis provides a robust framework to calculate the value of formation and value of control. It's the value of those two things that in the standard financial model do not exist. And there you have a whole different framework which helps you evaluate. A very simple problem now. Simple but realistic. Okay, we talked about oil exploration. I am offered an oil exploration lease. Suppose that the lease lasts forever. Usually these things have also time expiration. The outcome of the project is uncertain. Okay? Terms and assessed uncertainties, these are the state of uncertainty I have entering into the project, there are as follows. The right to participate, 10 million. 2 plots. I can test drilling both, okay? But I have limited resources. I'll be able to exploit only one well if oil is found. Usually exploitation of an oil well is a much more costly undertaking than the actual exploitation of an oil field. It's a much more costly undertaking than actually doing the test well. I can start at either plot 1 or plot 2 and stop. So I can go to plot 1, test. If there is oil, I can choose to go to plot 2 or stop and exploit plot 1. The same thing, I can do the same in plot 2. Okay. Assess probabilities to find oil in the 2 plots. Plot 1, 50%. Plot 2, 10%. If I do find oil, pair distribution is as follows. 25, 50, 25. It's kind of like, it's the bare minimum of something that resembles a normal distribution. A fat center and 2 thinner tails. That's why it's the 25, 50, 25. And then I have a plot 2. If we look for oil and fail to find, we are burdened with a test well. This is fine. Okay. don't think so much of the actual numbers. Let's think of how you formulate this problem, okay? Now, formulating this problem from the ground up is something very simple, okay? First of all, I need a mutually exclusive and exhaustive set of alternatives. I may not have a complete market necessarily, but still, I can always say, these are my alternatives. They're mutually exclusive and exhaustive. Okay? What can I do? I can participate in the deal or do not participate in the deal. No participation is one of my alternatives. Participation, it's split into 4 sub-alternatives. Test plot 1, proceed if oil is found, abandon the deal if not. Test plot 2, proceed if oil is found, abandon the deal or not, if not. Test plot 1, proceed if oil is found, if not, proceed with plot 2. Test plot 2, proceed if oil is found, if not, proceed with plot 1. Okay? For each alternative, assign the associated uncertainties and endpoint values, and basically you build a forward-looking probability tree. What would it look like? It's like this, very simple. So these are my decisions. Usually decision nodes are squared. Let's say the following. No deal. 0. Okay, this is my base case scenario. I don't pay anything, I don't expect to make anything. Okay? And then I say, go, drill 1. I think I made a mistake here. If I don't find any oil, I abandon. If I do find oil, I'm sorry, this is correct actually. If I do find oil, these are my elemental outcomes. And here they are. You know, I drill, 50% I don't find oil. What happens? I get burdened with a 10 I gave and 5 at test 12. 50% I find oil. What happens? I got these probabilities, these outcomes. Same thing with test plot 2. And the other thing is here. I test plot 1, I don't find oil, I go to 2, it's my priority list here. The other thing is I test plot 2, I don't find oil, I go to 1. If you just go over these, you'll see that these are the probabilities we described before, and the elemental outcomes in the end is just, you know, how much I've paid for the lease, how much I've lost in a, you know, up to that time in a failed attempt in test 1, and this is how much money I made. I collapse all this going backward, and what happens? I say that I've got going into the second oil, well, and if it has oil, stay there. If it doesn't have oil, go to oil well 1. This is my best course of action. It's got an expected value of 15. Very simple. It's just a sum of probabilities. Okay, one way. So that's my preferred course of action. Now, one big question. In this environment, and that's usually a real situation. Generally, if I'm an oil company, I cannot control whether I find oil or not. I cannot order oil to be there. But I can buy more information at substantial cost. Okay? So the question is, in this environment here, what would be the robust framework to find the value information? Essentially, we want to say, what if someone told me if there is oil in field 1? How much would I be willing to pay him to tell me if there is oil in field 1? Because if he tells me if there is oil in field 1, First of all, I will avoid going into field 1 if he tells me there is no oil there, so I don't get burdened in these eventualities with the $5 of the test oil, 5 million. And also, if he tells me there is oil in field 1, I can reassess my priorities vis-a-vis field 2. Because if he says there is oil in field 1, I would say, maybe it's worth staying there and not going to field 2. So what do? We recast the problem by placing our information node before our decision node. Remember, originally we had one decision which led into things which generated uncertainties, and it was going like that. A very nice linear set of probabilities. And I said, okay, this is the right course of action. Okay? Now, I'm splitting my uncertainties on either side of my decision. And I have some uncertainties which are resolved before I can make a decision. Maybe, just maybe, this has some value for me. And it has value to the extent that it prompts us to change the decision. Okay? Let's see all these, how they work in the tree. Now, value information is not additive. The value information about whether oil, well, region 1 has oil, and the value information over what, actually, the value information over whether, the value of information that tells me about both regions, whether they have oil or not, that's the way to express it, is not necessarily the sum of the information about oil region 1 and oil region 2. It could be less or it could be more. In this case, we'll see it's one of the cases where it's more. Value information, that's another big thing that differentiates decision analysis from looking at the financial markets. Value information is contingent on our own degree of uncertainty. Okay? I'm firm A, and I have these uncertainties. I have these uncertainties about these two regions. It could be that firm B has a different way of evaluating probabilities, or it has different opinions or different convictions. Firm B may think that they know exactly what's happening in plot 1, or they may be absolutely sure that there is oil in plot 1. Value information for them is going to be much different from the value information for me. I could be a complete idiot and be absolutely certain about my convictions, at which point value information is 0. I'm an idiot, but in my universe, the value information is 0. So this is what recasting the tree by placing uncertainty before decision would look like. Okay? Now, I place my uncertain node about oil well 1 in the beginning now. What probabilities would I assign in whether oil 1 has or doesn't have oil? I will assign the probabilities I already gave myself in the oil in the region 1 having or not having oil. Essentially, if I ask what I believe that there is 50% of having oil in region 1. Okay? And somebody asked me, if you asked a perfect clairvoyant, how much probability would he assign in having oil in region 1? What probability would you put? I would say 50%. Because what somebody asked me is a non-question. I have a 50%. I believe that what this guy will tell me is going to be 50%. Because I believe it's going to be 50%. So, I have this here. Then I have this uncertainty resolved. And then I have to have my decisions. Okay? Now, with this uncertainty resolved, okay, my decision is going to be different. And if you draw the schematics, you see here that if I have this uncertainty resolved, I will avoid making some wrong decisions, and the actual outcome of this thing here is going to be 17.25 if you just work out the trees. Which means that the value information, whether oil well region 1 has oil, is worth 2.25 to me, because my decision tree without this prior knowledge was worth 15. Now it's worth 17.5. So it's worth 2.5. Just think of a very simple thing. You know, I toss a coin. Okay? No, I'm sorry. I toss a coin. If I win, if it's tails, I win 100. If it's heads, I lose 100. Okay? Do I play the game? Is this a bad example? Because I was going to say, what's the value information? What the coin is going to come down? Excellent. Okay, I have a coin. Okay, there is one coin, but it's a lopsided coin. Actually, no, it's not a lopsided coin. I have a coin. Okay, if it comes tails, I gain 100. If it's heads, I lose 90. Okay? Is this a good deal?
Of course.
Of course. What's the value information on what's going to come out of this deal? It's a trick question. The value information.
I still know it's 50-50.
No, I say what's the value? Suppose you got this. Let me make this even more blatant. There is this coin. You toss it. It's a deal I'm offering you. You toss this. It's if heads comes, you gain 100. If tail comes, you gain 1. And I'm offering you this deal because out of the goodness of my heart. What's the value information?
You gain in both.
I gain in both.
Yeah.
What's the value information? Will you change your decision based on the information I'll give you?
No.
No. So what's the value information?
Zero.
Zero, exactly. So this is a counterexample. We've seen here in the test wells that information has value because knowing this, I avoid some pitfalls in my decision making. If there is a decision that I'll take anyway, value information is zero. And what we saw here, by recasting the tree like this, was the value of perfect information. I have everything resolved, okay, and then my decisions follow. In reality, information is never perfect. In reality, information is imperfect. Essentially, usually information gathering, detectors, test wells in oil exploration. I don't know what relevant quantity you have in maritime. But generally information gathering is faulty. I just need something which is more likely to show right than wrong. And suppose now, instead of having this perfect forecaster that could tell me if there is oil or if there is not oil, suppose I have somebody who said, if there is oil, I have an 80% probability of identifying the oil correctly. So if there is oil, I have an 80% of saying there is and 20% of saying there isn't. And if there is no oil, I have a 90% probability of saying there isn't and a 10% probability of saying there is. I could get it wrong asymmetrically. Now, how do we, the way we reverse those, what we want now is having this detector to see what he's going to give me given my 50-50 original assessment that there is oil. So, essentially what did I say? Can you read from here? I said, in my assessed form is my reality is 50% it has oil, 50% doesn't have oil. And my indication is as follows. Again, 50% will give me 80% accurate, 20% false. And here, not 10%, 90% accurate, 10% false negative. So these are the elemental probabilities. How do I do the inferential form? Is exactly the same way I reverse conditional probabilities. I reverse those by keeping the elemental probabilities the same.
Reverse what?
I say in here, I have a 50%. 50% there is oil. 50% no oil. 50% there is oil. I have an 80% there is oil. It indicates oil. And at 20% no oil. So the elemental probabilities are 40% there is oil and it's identified correctly. It's 10% there is oil and it's misidentified as there is no oil. And then here, there is no oil. 90% of saying no oil. So 45% of being no oil and being identified correctly. And I'm sorry, and 5%, 50% times 10%, that's 5% of no oil. 10%, 5% of being no oil and being misidentified as hot. Okay? Now, I want to ask myself, given my a priori assessment of whether there is oil or not, whether it's 50-50, what's going to be the actual outcome of the detector? Okay, it's not going to be 50-50. Now, it should be something close to 50-50, but not exactly, because if it was 50-50, then it would mean that I have a perfect detector. Or that, somehow the symmetry works. So in this case, what do I do? Okay, I start adding up. Let's see, I have yes, 40%. Yes, no, 10%. No, 45%. And no, yes, 5. No, yes, 5%. So in this case, what do I have? I add my guesses. This is my reality, my assessment. Assess. And this is what my detector says. I add my guesses. My detector will say yes. Will say yes in a. Will say yes. Sorry. Yes. In 55%. And my detector will say no in.
Another page.
I'm sorry, my detector will say no for 55%, and it will say yes 45%. 55%. Okay, and then have the same elemental probabilities. If my detector says yes, okay, to have the yes to be 40%, it will be 45% times 89%. So that the elemental probability is 40%, and so on and so forth. It's exactly the same way I reverse conditional probabilities. Now, given that I have now this faulty detector, I replace this tree here, okay, with that tree there, and recast. Instead of having this simple binary here, I replace it with a detector, and then my decision is here, and then my decision is contingent on those probabilities given that the detector said yes. It's a more complex tree. What is going to come out in the end is that the value of information is going to be much less than 2.5. This is the value of perfect information. Any kind of imperfect information is going to be worth less. I know this is just an introduction to a different way of looking at things. It was meant to be a whole lecture. We didn't do it for a whole lecture. Now, after we cast our trees and we find the value of information and we found all those uncertainties and elemental probabilities, what do? You remember when we did in the financial markets, we had the Taylor expansion, which is the first order expansion of things being unchanged. If one thing changes, everything else being unchanged. And we had the principal component analysis. We didn't have that. It was basically taking out of the things that could affect me, the important ones, and then looking at them with a magnifying glass. So the tornado diagram, it would look like this. It's essentially a list of all my uncertainties and how much they can affect me, given that everything else remains the same. And then I would pick out some of those uncertainties and essentially build a tree. If I pick, say, 5 uncertainties with three eventualities each, I have 3 to the 5th. That's about what, 81? No, it's 240 something. I have 240 elemental outcomes. I write those in a cumulative distribution function, and then I take the average. It's kind of like, brushing black and Scholes, and this is my entropy. Okay. And then I can start playing with different levers to try and, if this thing has a tail, which I don't like, of like fat tails, then I play with different levers, try to bring the whole thing smooshed in together. So, just very briefly, how I would deal with a problem like this outside the financial sector. Okay? What I'm missing is my Ito process. There is no Ito process. I'm building the Ito process. What? Through this tree. This tree is my Ito process. And the very last thing, just to keep you guys thinking, because it has kept me thinking a lot, the very last thing. Real options. Who has ever heard of real options? Who's heard of real options? Let's say I want to value a piece of land. Okay? One way to value a piece of land is I buy this piece of land and I build something in it. So how much can I sell this something? If I can build a house which will cost me 10, I can sell it for 30. I'm willing to pay as much as 20 for the piece of land. Another way to look at this is the following. Buying a piece of land gives me the option to build a house. On the other hand, if things go sour in the housing market, I don't build the house and I just own a piece of land, which is worth nothing. So, a piece of land essentially is kind of a call, it's a call option on the price of the houses, which is a more sophisticated way of seeing it than just, a balance sheet, that much for the house, that much. Because the way housing prices move, they could go very high, they could go low. If they do go low, I don't need to lose money. I can just refuse to develop. So, some personal thoughts. Basic binary option, I don't mean the binary option, it's an option theory on 2 states. It's not a theory on binary options. Very brief, have you seen that before? No. This is the very beginning of Black and Scholes. The very beginning of Black and Scholes. very, very briefly, we live in a two-state world. Okay, that's how Black and Scholes start. Guy got the Nobel Prize for this. You see where he got the Nobel Prize from. We live in a two-state world. Okay, I have an asset which can go up. I'm sorry. I have an asset. That's the basic building block of the Ito process that you see. My asset. It can go up or it can go down. Probability of going up is P. Probability of going down is 1 minus P. Didn't tell you anything new. I have my riskless asset. I have 1 unit of money. In the up state of the world, it will go to 1 plus R, because that's the riskless rate. In the down state of the world, it will go to 1 plus R, to R, because it's riskless. I don't care what it. And then I have the price of my option. The price of my option C, if it goes up, I'm just saying, by definition, it is the maximum zero, and I call this CU, and this is the maximum plain vanilla call option. I said nothing out of the ordinary. This is just a matter of definition. The option will give me the maximum of the price minus the strike and 0. Because an option, I can exercise it if the price is to my advantage. I cannot exercise it if it's not fine. Okay? Very simple. Now, naively, we would expect the option price, and this was the big leap that Merton and Scholes did in the 70s. Naively, we would expect the option price to be something like this. Probability of going up times the option of the price in the up state, the probability of going down times the option of the price in the down state. It turns out it's nothing like this. And there's a very, very robust proof why it can be nothing like this. I can say that by purchasing X units of this, okay? I'm sorry, X units of the stock and B units of the risk-free asset, I can replicate the outcome of this option in both states of this little two-state world. Okay? And if I solve, I have X units of this, X units of this, plus B units of this equals this. Okay? I have two unknowns, X and B. I have two equations, the up state of the world and the down state of the world. And I can tell you